For over 70 years, Warren Buffett has taken a few $1,000s from a childhood paper route and compounded it into one of the largest fortunes on the planet. People constantly ask him to compress all that experience into something actionable. In response, he hands them 6 rules, a system that sounds too basic to explain such massive success. The standard approach to investing is driven by noise and dopamine. Most people look at the chaotic trading floor and ask one question: how much can I make? Buffett avoids stock tips in favor of a strict algorithm. He uses 2 distinct boundary layers designed specifically to block out human excitement. Sustainable wealth requires constructing a structural defense against your own psychology. The first filter is rule number 1: never lose money. Buffett treats this as a cold mathematical necessity. This chart shows the brutal asymmetry of loss. A 50% drop requires a 100% gain to get back to even. A 90% loss requires a 900% gain to reach the baseline. Losses mathematically compound against you. To survive this math, Buffett demands a margin of safety. You only buy something for significantly less than what it's worth, providing a shock absorber if your initial assumptions are wrong. This creates a mandatory sequence for every decision. Before calculating potential upside, you must answer, how much could I lose and can my capital survive it? If the opportunity fails the survival test, the size of the potential reward stops mattering. Safeguarding capital means only playing games where you completely understand the rules. During the dot-com boom, while the rest of the market chased a complex tech bubble, Buffett parked his capital in businesses that were entirely mundane. He restricts his investments to his circle of competence. His decades-long relationship with Coca-Cola fits this boundary perfectly. The business sells a drink people already want, in more places, with a model that hasn't shifted in a century. No breakthrough technology to predict. This diagram represents a 60-second test. If you cannot explain out loud, in under a minute, exactly how a business makes money and why that remains true in 10 years, it stays outside your circle. Intelligence does not protect you from unpredictable complexity. Only rigid, simple boundaries do. Applying these 2 filters means you will deliberately miss out on making money from popular trends. It takes psychological endurance to sit on the sidelines holding a boring asset while the rest of the market appears to be getting rich quickly. These missed opportunities represent a calculated insurance premium paid to protect your foundational capital. Discipline requires flatly refusing to take a risk you cannot confidently evaluate. Next time a hot opportunity appears, ignore the upside. Run the downside math, check your competence boundary, and walk away. This is how capital survives and grows for 7 decades. You wake up, you clock in, you trade your physical hours directly for a paycheck. It is the default mechanism for survival. Because this daily transaction is so direct, we assume the math of building wealth works the same way. The linear illusion tells us that if you want to make twice as much money, you simply have to work twice as hard or twice as long. We have other deeply ingrained financial instincts too. Biologically, when we see danger, like a sudden market crash, our impulse is to flee to safety. Psychologically, if we put effort into a strategy and don't see immediate results, we assume the process is broken and pivot to something new. Yet the most successful investor in history, Warren Buffett, built his fortune by deliberately doing the opposite of what human nature dictates. Breaking out of the working class trap requires a sequence of 5 rules. It begins with the foundation, protecting your spare capital and staying inside what Buffett calls your circle of competence. But to reach the highest levels of wealth, you must master 3 profoundly unnatural behaviors: enduring agonizing boredom, running toward economic fires, and severing the link between your time and your money. Rule 3 is compounding. A graph mapping wealth against time shows why this process is deceptively undramatic. Money doesn't grow in a straight line. Instead, it stays flat for years. But after decades of accumulating math, the curve suddenly and violently bends upward. Buffett himself is the clearest proof of this timeline. By his own account, the overwhelming majority of his net worth materialized only after his 50th birthday. This creates massive psychological friction. We are wired to crave immediate feedback. Spending a decade in the flat portion feels like failure. even when the underlying process is working exactly as intended. Because the visible evidence is scarce, the real enemy is the urge to interrupt the process. We pull money out, we panic sell in downturns, or constantly switch strategies just to feel a sense of action. The highest leverage decision you can make in investing isn't picking a slightly better stock. It is having the patience to survive the gap between quiet effort and visible payoff. While compounding requires enduring boredom, Rule 4 requires enduring sheer terror during market panics. Buffett's advice is to be greedy when others are fearful. In 2008, the world froze. Banks were collapsing, and most investors were either frozen with fear or actively liquidating everything they owned. Right in the middle of that panic, while the crowd was moving in the opposite direction, Buffett made a massive investment in Goldman Sachs. Because he acted while everyone else was paralyzed, that deal alone generated billions in value. The mechanic is straightforward. Panics create discounts. This chart maps a stock's price against intrinsic value. When blind fear takes over, the price plummets much faster than real-world value deteriorates. This resulting empty space is the opportunity zone, turning courage into long-term return. This does not mean recklessly buying any stock simply because it is crashing. It requires having done the work in calmer times to know what a business is actually worth. Acting here is only possible if you have Rule 1 and Rule 2 already in place: spare capital that survived the crash, and the judgment to stay within your circle of competence. This brings us to Rule 5, the purpose of enduring the boredom and the panics. Without a form of income that is detached from your physical presence, your earning potential has a hard ceiling dictated by the clock. There are only so many hours you can work. Earning while you sleep means acquiring assets that generate profit regardless of your daily labor, like dividend-paying index funds, insurance operations, or cash-flowing businesses. This breaks a standard expectation, the requirement of a paycheck immediately after a day's work. True passive income is the result of effort that is front-loaded. Rule 1 provides the capital to buy the asset, and Rule 2 ensures you understand what you are buying. This allows the income to compound over time, bringing Rule 3 right back into the picture. These rules form a sequential blueprint. Rule 3 builds the capital, Rule 4 accelerates it during crises, and Rule 5 converts it into perpetual motion. Successfully executing this blueprint requires continuously overriding your basic psychological programming at every single step. Amassing this snowball and exploding panics creates a significant pile of capital, but the raw numbers on a balance sheet are not the end goal. The value lies in the resulting optionality. A person whose income is entirely dependent on their labor has no real freedom to slow down or walk away without immediate financial consequences. Severing the link between your time and your money provides a practical result: the ability to walk away, slow down, and direct your own time. When we look at the absolute giants of investing, it's incredibly tempting to just assume their wealth is the result of some secret tip, maybe insider access, or honestly, just blindingly good luck. But the reality? Well, it's actually far more grounded. It relies entirely on a very specific set of rules, executed with just relentless discipline over time. So today, we're going to break down these 6 rules and show you exactly how this wealth machine actually works. Okay, let's dive right into this. Here is our blueprint for today's Explorer. First up, we'll look at the ultimate multiplier, which is learning. Then we'll explore the closed-loop system. After that, we'll cover 3 fatal investing mistakes. And finally, we'll talk about applying these rules today. All right, Section 1, the ultimate multiplier, continuous learning. So I'm going to reveal something that might actually surprise you. When we talk about the world's greatest investors, we almost always picture them frantically buying and selling on these chaotic, noisy trading floors, right? But their final, most absolutely crucial rule for success has nothing to do with trading at all. Just think about this staggering number for a second: 80%. Warren Buffett, literally one of the most successful investors in human history, spends roughly 80% of his working day doing just one wonderfully mundane thing. He reads. He reads annual reports, newspapers, books, financial filings. And what's truly amazing about this is that this quiet habit of knowledge gathering hasn't materially changed in over half a century. It completely shifts our focus away from that dramatic high-stakes trading to a much quieter but far more powerful daily routine. And Buffett's longtime business partner, Charlie Munger, he put this even more directly. He observed that nobody he knew who was genuinely successful over a long period did it without reading constantly. And conversely, nobody who read constantly failed to become at least reasonably successful over time. It really didn't matter if they started out unusually gifted or not. The fundamental truth here is that knowledge, when you apply it consistently, compounds in almost exactly the same way that money does. The thing is, a quiet habit, like 30 minutes of daily reading, often feels completely invisible in the short term. I mean, a single day of reading rarely feels like it changed anything at all. But fast forward a decade, and that invisible habit manifests as something highly visible. It turns into a calm, perfect decision made exactly when a crisis hits. Knowledge built this way doesn't usually look like a dramatic lightning bolt or an aha moment. It just shows up as a much better decision, made calmly, right when making a terrible emotional decision would have been incredibly easy. Moving on to Section 2, the closed-loop system. To really understand the mechanics of this wealth machine, we have to look at how these rules mutually protect each other. You see, continuous daily learning doesn't just exist in a vacuum. It acts as the hidden maintenance engine running underneath everything else. Imagine a single dollar moving through this machine step by step. Step 1, you protect your capital, so you actually stay in the game. Step 2, you invest only in what you understand, which is your circle of competence. Step 3 is compounding. That's the engine. But remember, it only runs on capital that actually survives steps 1 and 2. Step 4 is acting boldly during a crisis, which requires the capital and the judgment you've already built up. Step 5 is earning passive income, the ultimate result of all that compounding. And Step 6, learning daily, well, that is the maintenance system ensuring your judgment keeps improving at every single step of this journey. Think of this rule stack exactly like a giant game of Jenga. You absolutely cannot treat these 6 rules as separate pieces of advice that you just pick and choose from based on your mood. They're a closed-loop system. If you pull any single rule out of this stack, the whole thing gets incredibly wobbly. And if you get a little too greedy, the whole shebang comes crashing down. For example, if you try compounding without protecting your capital, eventually a massive loss is going to wipe out years of your gains. If you want passive income, but you stop learning, your income stream will eventually get disrupted by a rapidly changing world. They were never meant to be sampled individually. They were a mutually protective system. All right, Section 3. 3 fatal investing mistakes. So knowing the rules is one thing, right? But what actually breaks this loop? What are the recurring traps that constantly destroy long-term wealth building for so many people? Well, the data points to 3 very specific behaviors. And the tricky part is, they disguise themselves as good investing practices, but they are actually deeply destructive when investors try to cherry-pick from this system. The first mistake is a classic misunderstanding of Rule 4. We have all heard that famous quote, "Be greedy when others are fearful." But way too often this gets dangerously twisted into a reckless permission slip to just buy anything that happens to be crashing. Real contrarian courage relies on a true, deep understanding of a company's underlying value, and you build that understanding during the calm periods through your daily learning. You can't just manufacture conviction out of thin air in the middle of a market panic. You can only apply the conviction you have already built. So let's lay out these 3 fatal mistakes clearly. Number 1, like we just talked about, is recklessness disguised as courage. No, 2 is neglect disguised as patience. Now, compounding absolutely requires patience, for sure. But leaving a bad investment untouched for a decade, just hoping time will somehow magically fix your mistake, that's not patience. That's neglect. And no, 3 is skipping the daily learning habit. It's so easy to skip because it feels way less urgent than hitting a buy or sell button. But skipping that learning slowly rots the foundation of every other rule in the system. And finally, Section 4, applying the rules today. Let's bring these billionaire concepts right down to our level, to your own wallet. Here is what the chronological journey of an investment should look like for you right now, regardless of where your portfolio is currently sitting. First, before a single penny moves, you filter out risk. Ask yourself honestly, could I survive the total loss of this capital? Second, before you hit buy, prove you are actually in your circle of competence. Can you explain the asset out loud, in simple terms, in under 1 minute? If not, walk away. Third, once you're invested, leave it alone. Leave it alone far longer than feels comfortable so compounding can actually do its work. And fourth, continually evaluate its value. That way, when market panic inevitably hits, you already know if the fear is rational or if it's just a temporary disconnect that you can capitalize on. But here is the absolutely crucial point. None of those previous steps are going to work if you aren't continually upgrading your judgment. You have to treat structured learning as a daily habit, with the exact same seriousness as brushing your teeth. It is not some occasional activity for when you just happen to feel motivated on a Sunday afternoon. A calm 30 minutes with a financial report or a book done consistently for years is a genuinely rare habit. And rare habits, that is exactly where your most durable financial advantages are always going to live. I really want to emphasize this heavily. Discipline builds empires, not luck, not a single brilliant stock pick. You absolutely do not need Warren Buffett's billions to start using this closed-loop system today. But you absolutely do require his level of discipline. You have to apply it honestly, at whatever scale you are currently operating at, starting with the very next dollar that passes through your hands. And it's important to remember that these rules don't actually get easier when you have less money. If anything, they're so much harder to stick to when the dollar amounts feel too small to even matter. But surviving those early quiet years is literally the only way you ever reach the massive, explosive growth of compounding later on. So I'll leave you with this final provocative thought to consider. Are you willing to apply all 6 rules, build that daily learning habit, and hold your discipline long enough for the curve to finally bend upward for you too? Start building your wealth machine today. Thanks so much for joining me.